Hello and welcome to November 2022, the Advanced Projections Economic Report. This is Rich Vessel, the founder of Advanced Projections. Here's our review of the highlights from October. Employment figures for October came in with a still solid new jobs figure up 261,000, but unemployment moved back up slightly to 3.7%. We expect that unemployment should eventually begin to gradually move further upwards and relatively soon. At these low levels, the Fed will stay fully focused on inflation, as repeatedly confirmed by Chairman Powell, the Federal Reserve Open Market Committee, and other Fed governors. Just this morning, the annual CPI inflation through October was announced, with consensus expectations for it to be around 7.9%. The actual reported value was 7.7%, below our expected range. Sticky price inflation is not out for October as of this date, but the September reading was 8.4% and will likely stay near 8% for the October reading. Equities markets gained a few percent in August, but gave those back gains in September, with further losses added in, setting a new low for 2022. With the inflation figures that came out on 10/13, equities traded frenetically but resumed their downward trend for a few days. As of this release, the markets have bounced from October's lows and appear to be testing overhead resistance around 3,900 on the S&P 500. The overzealous market response today to the 7.7 CPI reading may fuel another temporary bear market rally, just like we saw earlier in the summer. Our indicator system keeps our recession risk level at 90% due to more steeply declining leading economic indicators, a continuing hawkish Federal Reserve monetary policy stance, and a newly read APYC yield curve indicator. There are now no AP indicators showing green, and only 2 are just skirting the boundary between red and yellow. The remaining 4 are solid red. Here's a quote from Thomas Barkin, president of the Federal Reserve Bank of Richmond. We've used this a few months in the past. He said, "There is a path to getting inflation under control, but a recession could happen in the process. If one does, we need to keep it in perspective. No one canceled the business cycle." Well, that's exactly what our indicators are designed to monitor, is the business cycle, and it certainly hasn't been canceled as far as the indicators are concerned. 9 months ago, in early February of 2022, we gave an extreme risk warning for equities as the Fed was preparing to begin their quantitative tightening program in March. Here in early November, there is an onset of a rush to cash after significant losses in the equities markets, and as people are finally beginning to realize the resolve of the Fed in their long-game battle against the inflation dragon. That cash may feed a temporary bounce in equities, but that is not likely to stand up against all the forces at play elsewhere. And certainly a lot of that cash got dumped back into the markets today, with enormous gains in the 4, 5, 6% area in one day. The NBER, as the only official authority for U.S. recession declarations, makes their recession starting and ending determinations well after the start and events have taken place, by many months to well over a year. So these declarations are helpful only in a historical or academic context. But for investors and business planners, they need to have a better system of recession leading indicators, and that would be what you are reading here in the Advanced Projections Economy and Recession Monitoring Systems. Here are the underlying economic details. Year over year, CPI increases, supply chain issues, and the tight labor market have continued to plague many aspects of the economy. General expectations out just ahead of the October announcement for inflation were for 7.9%, but it came in below that at 7.7%, beneath the range we were expecting. The Federal Reserve will not be swayed much by that number, as the underlying sticky inflation numbers are not coming down as rapidly. and energy costs will have an upward effect on readings in the months November through March. The Bureau of Labor Statistics employment and the Federal Reserve's intentions, unemployment continues to remain well below 4% over the past 10 months, now at 3.7%, with new job gains in October of 261,000. We expect those gains to continue but dwindle for another few months in a restrained but downward fashion. We expect to see an accelerating pace of layoffs begin by spring of 2023. There was a slight increase to 10.7 million job openings, and for every unemployed person who is looking for work, there's still over 1.7 times that of the 6 million persons who are unemployed. The workforce declined a tiny fraction with a small monthly bump up in the not in the labor force number. The table that we include, household data from the Bureau of Labor Statistics, shows the employment situation at the end of October, with the general improvements in the employment picture we have been experiencing over the past 3 months, and as also compared to a year ago. As we keep saying, the currently solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their rate increase script, as well as in their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so with their 6 rate increases in the March to November timeframe and within their last available FOMC meeting minutes. Look for continued activity in these areas when the Fed returns with their next steps to be announced on December 15th. We expected the November and now to the December FOMC meetings to result in 75 basis point increases at a minimum. We do not expect any delicacy or wavering on their part for the remainder of 2022 and into the beginning of 2023. Third quarter 2022 corporate earnings outside of the energy sector are aggregating negatively. In the second quarter, outside of the energy industry, all sectors reported declines in earnings growth. The third quarter didn't look very different. The following charts that we've included in our written report are from reports issued by FactSet for the S&P 500 second quarter and third quarter ex-energy, that means without energy, earnings. They very clearly reveal exactly what we expected in our last 2 reports from the mainstream companies for the third quarter. These decreasing expectations were also confirmed at a recent investor conference sponsored by Goldman Sachs, but we clearly expected third quarter growth to be 0 or negative as well. So if you look at the written report, you will see how the 2 charts compare. The old chart where we basically predicted that the third quarter would be worse than the second quarter, and then an accompanying chart which has the results from the third quarter, which show that, as we projected, the growth was negative and well below the second quarter. Now it looks like growth will be negative for the entire year as well. The June, July, and October interest rate increases had already had a significant effect on the price of oil, driving it down more than 25% and hitting energy exploration equities hard as well. As we are facing further significant rate hikes, and clearly for other more political reasons, OPEC and Russia recently cooperated in an agreement to return to their 2 million barrel per day production cuts at levels which were in force during the first quarter of this year. This announced production cut temporarily halted oil's continuing downward trend, which was looking like oil would be potentially back below $80 by the end of the third quarter. Depending upon political developments, these production cuts may create a plateau for oil prices between $85 and $95 a barrel for several months at least. This will add to inflationary pressures, as they already did in October. Energy sector experts expect corporate earnings from energy to begin declining from the second quarter of next year through the fourth quarter, so they will cease to support profitability growth in 2023. Natural gas prices may soon end their pricing breather that resulted from a fire at the Freeport, Texas export facility. That facility returns to service this month, and liquefied natural gas export activity will be back to near maximum. That will also keep prices up and electric power production costs high, as natural gas accounts for about 40% of the U.S. power generation mix. Several new LNG facilities are under construction, and their export activities will keep upward pressure on natural gas prices and hence electricity as well. High natural gas prices have stimulated a renewal in well development, and there are now more drilling rigs in operation than there were in late 2019. On the supply side, for natural gas, the exploration industry is beginning to complete wells that were unfinished during 2020 and in 2021, and will put them into production over the coming months. However, we expect high natural gas prices to persist through the winter as long as Putin tries to hold Europe hostage with restricted natural gas supplies, and as long as reduced available supplies and stored volumes here domestically persist through the upcoming winter. Now, for equities, in July, the S&P 500 broke back upwards from its June low and closed the month of July around 4130, the same as it closed out April and May. That meant it was back solidly into bubble territory, and moves made between July 31st and August 12th put on another 140 points higher still. However, we also said that we expected resistance to set in around those levels based upon simple index chart reads, but a turnaround in market sentiment would have to depend heavily on some kind of negative news. As we fully expected, inflation was reported to be alive and kicking on September 13th, so the counteractive news we were looking for materialized. The markets responded negatively. All major indices were down 4 to 5% within one day. By the middle of October, new lows were set in all the major indices, with the S&P 500 down more than 25% for the year. Now, with the S&P back up and testing resistance around 3,900, a similar situation seems to be in play. Negative news, perhaps from the intransigence of inflation or election dramas yet to play out, is probably needed to drive the markets lower. We continue to expect significant further declines in equities and bonds in the intermediate term. A return from the current index level just below bubble territory to warm market levels would take the S&P down to about 3650, and a correction to the mean would be near 2900. Now, today's price action, that massive uptick because of the CPI print, is really, we don't expect it to last. That is just what happened in July, and the next month's data that came out drove the markets right back down again. So, in a typical bear market, negative investor emotions carry enough downward momentum to drive indices significantly below the mean towards and through the inevitable retail investor emotions of despair and capitulation when finally the selling ends. There is no current reason to expect anything different this time, as the Fed appears to be highly resolute in their attack on inflation, and that means more significant rate hikes should still be expected, beginning with the next one in mid-December. They have clearly stated what their targets are, that inflation has not yet begun to respond as needed, and they are dead set against pausing or quitting too early. Also, in his remarks after the rate increase at the beginning of this month, Chairman Powell said that the window is closing on the ability to manage a soft landing. And with today's action, I'm sure that window is now just open a crack. So we'll see how things go, throughout the next couple of months. We do maintain an internally used chart called the S&P 500 EKG, and is showing the classic signs of an incipient market heart attack with this high-frequency, high-volatility trading, just as it did ahead of the Great Recession downturn. If this appearance continues, we'll publish the chart in an upcoming monthly report. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets, and for breakdowns in this metric which appear ahead of real economic downturns. This is continuing evidence of something that is seriously discouraging many risk takers from borrowing to finance equity speculation. And the chart, courtesy of Advisor Perspectives, shows that the margin borrowing is continuing to decline and was down 3.5% more in the month of September. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.